Saturday, March 16th, 2013, Nicosia, Cyprus. It's a warm spring morning. A small business owner, let's call him Elias, walks to his local bank branch. He needs cash for the weekend. He inserts his card. He enters his PIN. He waits for the mechanical whir of the dispenser. But there is no whir. The screen flashes a generic error message, out of service. Annoyed, he walks 2 blocks to a different bank. Same result. He checks his phone. His banking app isn't loading. He doesn't know it yet, but he is standing at ground zero of a financial experiment that is about to change the world. By the time the banks finally reopened days later, the world was different. If Elias had 100,000 euros in his account that Friday, by Tuesday, nearly half of it was gone, vaporized. It wasn't a robbery. It wasn't a hacker. It wasn't a clerical error. The bank had taken his money to pay its own debts, and the most terrifying part? It was perfectly legal. Most people remember Cyprus as a footnote, a freak accident on a small island. They are wrong. Cyprus wasn't an accident. It was a prototype. It was a live field test for a new set of laws that have since been quietly passed in the United States, Canada, the United Kingdom, and the European Union. You believe that the money in your savings account is yours. You believe it is sitting in a vault waiting for you. But if you read the fine print, the really fine print, you will discover a terrifying truth. You don't own that money, and if the system crashes again, you aren't getting it back. Welcome to the era of the bail-in. To understand why your money is at risk, we have to unlearn the very first thing we were taught about banking. We have a cloakroom mental model of banks. When you go to a museum and check your coat at the cloakroom, you hand it over to the attendant. He gives you a ticket. When you come back, you give him the ticket and he gives you back your specific coat. The museum doesn't own your coat. They're just watching it. If the museum goes bankrupt, the creditors can't come and sell your coat to pay the electric bill. The title to the property remains with you. We think banking works the same way. We think we are depositing money for safekeeping, but in the eyes of the law, the word deposit is misleading. When you hand your cash to a bank teller or transfer a paycheck via direct deposit, a legal transaction takes place. The title to that money, the legal ownership, transfers instantly from you to the bank. The money is now theirs. So what do you have? You have an IOU. You have a promise that the bank will pay you back upon request. In financial terms, you have become an unsecured creditor. This distinction is boring until it becomes tragic. An unsecured creditor is the lowest form of lender. You have no collateral. You have no lien on the bank's assets. You are at the very back of the line. For decades, this didn't matter. We lived under the illusion of safety because governments protected the banks. But the rules of the game changed in 2008, and they changed because the world ran out of money. Cast your mind back to the great financial crisis. Lehman Brothers collapsed. The global credit markets froze. Wall Street was on fire. To stop the world from entering a new Great Depression, governments in the US and Europe executed the infamous bailouts. They took trillions of dollars of taxpayer money, your future taxes, and injected them into the failing banks to keep them alive. It worked, in the sense that the ATMs didn't stop working, but it was politically toxic. The public was furious. Why should teachers, plumbers, and engineers pay for the reckless gambling of hedge fund managers? The global elite met at the G20 summits in the years following the crisis. They looked at the balance sheets of nations. Sovereign debt was exploding. They realized a hard mathematical truth. The next crisis would be bigger than 2008, and the governments would be too broke to bail out the banks again. They needed a new mechanism. They needed a way to save the banking system without using taxpayer money. If they couldn't use money from the outside, a bailout, they would have to use the money on the inside, a bail-in. And what money is inside the bank? The deposits, your savings. This isn't a conspiracy theory. This is codified law. In the United States, it's buried within the Dodd-Frank Act, specifically Title II, under the Orderly Liquidation Authority. In Europe, it's the Bank Recovery and Resolution Directive, or BRRD. In Canada, it's the bail-in regime for domestic systemically important banks. The language in these documents is dry, boring, and designed to be ignored, but the mechanism is brutal. Here is how a bail-in scenario plays out in reality. Let's say a major global bank, we'll call it Apex Bank, makes terrible bets on the derivatives market. They are insolvent. In the old days, they would file for bankruptcy or get a government check. Now, the regulators step in on a Friday evening. They execute a resolution. They look at the bank's liabilities. They see that Apex Bank owes $50 billion to bondholders and $100 billion to depositors like you. To save the bank, they need to erase debt. So they wave a legal wand. On Monday morning, you log into your account. You had $50,000 saved for a house deposit. Now the screen says you have $30,000. Where is the other $20,000? It hasn't disappeared. It has been converted. The bank has forcibly used your money to buy stock in itself. You are now the proud owner of stock in a failing bank, stock that is likely plummeting to zero. They didn't ask you. You didn't vote on it. It happened automatically because, remember, you are an unsecured creditor. You loaned them the money, and they just decided to pay you back in worthless equity instead of cash. Now the skeptics are screaming, "But the FDIC, the insurance, my money is insured." We'll get to the insurance myth in a moment, but first, we have to talk about who is standing in line in front of you. In bankruptcy, there is a hierarchy. Who gets paid first? You might assume that mom and pop savers should be the priority, but in the modern financial architecture, there is a class of investors that has super priority: derivatives. Derivatives are complex financial bets, options, futures, swaps. The global derivatives market is estimated to be valued at over $1 quadrillion, notional value. It is a number so large the human brain can't comprehend it. It is 10 times the size of the entire global economy. The banking laws have been written to protect this market at all costs. Why? Because if the derivatives market unspools, the entire global payment system freezes instantly. It is the nuclear reactor at the center of the economy. So, under current bankruptcy codes, derivative counterparties often have the right to claim collateral before the bankruptcy is even fully settled. They sweep the accounts clean. Picture a sinking ship. The lifeboats are limited. The law says the billionaires in the derivatives casino get the lifeboats first. The bondholders get the lifeboats second. The depositors, you and me, are left on the deck holding a plastic bucket, told to start bailing. Your deposits are the shock absorber designed to protect the integrity of the derivatives bubble. But surely, you say, the FDIC guarantees my deposit up to $250,000. Yes, the Federal Deposit Insurance Corporation, FDIC, exists, and for the failure of a small regional bank, or even a couple of medium-sized banks, it works perfectly. Silicon Valley Bank failed, and everyone was made whole. But the bail-in laws weren't written for small banks. They were written for the systemic collapse, the big one. Let's look at the math. It is public record. The FDIC Deposit Insurance Fund, DIF, holds a reserve ratio. This is the amount of cash they actually have on hand versus the amount of deposits they insure. Historically, this ratio hovers around 1.3%. For every $100 of insured money in the banks, the FDIC has about $1.30 in its vault. This is a fractional reserve insurance scheme. It relies on the assumption that banks will only fail one at a time. But in a 2008-style contagion, where 5 or 6 megabanks wobble at once, that 1.3% vanishes in hours. At that point, the FDIC is insolvent. The government has two choices: print trillions of dollars to refill the FDIC, hyperinflation, or allow the bail-in to happen. Given that inflation is already a political nightmare, the bail-in becomes the only viable option for the state. They will sacrifice the savers to save the currency. This brings us to the most insidious part of the puzzle, the closing of the exits. If you know a bail-in is coming, your rational move is a bank run. You go to the bank, you withdraw your property in physical cash, and you hold it. Once the cash is in your hand, you hold the title again. The bank cannot bail in a stack of bills sitting in your home safe.
But have you noticed the war on cash lately? Limits on cash withdrawals, questions from tellers when you take out more than $3,000, the disappearance of ATMs, the push for central bank digital currencies, CBDCs. We are told this is for convenience, it is for fighting terrorism, it is for hygiene. But structurally, a cashless society creates a prison. If physical cash is eliminated, you cannot withdraw your money from the banking system. You can only move it from Bank A to Bank B. If the entire system is under stress, there is no exit. You are trapped in the digital ledger. You are a captive creditor. A cashless society is the prerequisite for an effective bail-in. It ensures that when the crisis hits, the sheep are already locked in the pen, waiting to be sheared. There's a financial theorist named Jim Rickards who refers to this future scenario as Ice 9, a reference to a Vonnegut novel where all the water in the world instantly freezes. In the next crisis, the government won't wait for the bank run. They will freeze the system first. Imagine waking up. Your app says system maintenance. Your credit card declines at the grocery store. The news says it's a temporary holiday to stabilize markets. During that freeze, the restructuring happens. The lawyers rewrite the balance sheets. The derivatives are paid. The bonds are written down, and your account is given a haircut. When the system unfreezes a week later, the wealth transfer is complete. You didn't lose your money to market forces, you lost it to legislation. I am not telling you this to make you panic. Panic is useless. I am telling you this so you can reclaim the concept of ownership. We have become lazy with our capital. We leave our life energy stored in unsecured loans to leverage addicted institutions because it is convenient. The antidote to the bail-in is true ownership. This means holding assets that have no counterparty risk. It means owning stocks in your own name, direct registration, not in the street name of a broker who could also fail. It means owning physical precious metals that are outside the digital grid. It means owning productive land. It means owning treasury bills directly from the government, bypassing the bank entirely. These assets cannot be bailed in because they are not liabilities on a bank's balance sheet. They are property, your property. The financial system has evolved into a mechanism that privatizes gains and socializes losses. But since the public refuses to pay for the losses through taxes anymore, the system has decided to take the payment directly from the accounts of the depositors. The bail-in is not a possibility. It is a signed, sealed, and delivered legal reality waiting for the trigger to be pulled. The next time you log into your bank account and see that number on the screen, don't look at it as your money. Look at it as what it really is, a loan you have made to a hedge fund that also happens to offer checking accounts. And ask yourself, is that a loan you really want to make? If this video gave you a new perspective, help spread this knowledge by hitting the like button. To stay ahead of the curve and build your own systems, make sure you're subscribed. I'll see you in the next one.